So let's continue our introduction to investing. Let's talk about returns. Everybody's interested in them. The return is the sum of income plus capital gains. In investments, income is the cash flow from dividends and interest. Capital gain is the increase in the value of an asset. It's the difference between the purchase price and the ultimate sales price. So the total return is the sum of those two values. We would also like to be able to put this in some percentage formats. So the anticipated return that we have may not equal our realized return. So to calculate the rate of return, we take the dollar return that we have divided by the beginning value, and that will give us our rate of return. But again, the return that you get may not equal the return you wanted. This is actually a very good definition of risk. What we expect is not typically what we get. It could be more or it could be less. Here is an example of how we could calculate this. Disney was selling for $90.29 on December 1st. During the year, it paid 75 cents in dividends. On 11/29, you could sell it for $116.91. How can you calculate that return? You could do this in Excel with the formula. So the beginning value, 90.29, enter the ending value, 116.91. The difference between these two is our capital gains. The cash flow was 75 cents, and this took 1 year to happen. So this gives us our return for the year of 30.31%. Let's look at another example, though. Molson Coors was selling for $51.99 on November 1st of 2022. On November 1st of 2024, it had a closing price of $60.36. During this 2-year window, it also paid $3.34 in dividends. What's the return and the holding period for this investment? Again, entering our capital gains, we bought it for $51.99 and we could sell it for $60.36. The cash flows for the time period was $3.34, but now the time horizon was a 2-year window. So the return on our investment was actually $22.52 over the entire 2-year window. However, if you annualize that, what do we actually earn on average per year? That's what we refer to as the holding period return. You see here it is annualized. That is roughly 10.69% per year. If you multiply 10.69 by 2, that's obviously what, 21 odd percent if you multiply by 2. Now, there's something in the world called time value of money, so that's going to alter just a wee little bit and what the actual return would be over that time period. Speculation. Is there a difference between investing and speculation? Actually, there's no real difference except for the types of risks the investor takes. When investing, we can imagine a more conservative form of analysis and capital allocation. Speculation itself implies more risk. So investing can imply a buy and hold strategy, where speculation can imply acting quickly in and out of an investment to take advantage of perceived opportunities. there's a concept called liquidity, and there are several definitions depending on the context. But here is how easy it is for us to turn assets into cash. So there are two parts to this definition. How quickly can the asset be converted into cash? But the second part is just as important. How does that affect the sales impact price, right? So how does that sale itself affect the price? In other words, can I maintain value and be able to sell very quickly? This is the tricky part. There are many assets that are just difficult to sell. It takes time. So if you want to do it quickly, you may have to suffer value in order for the transaction to help happen quickly. So converting quickly, but losing much of the asset's value is not very liquid. Think about your house. Could you sell your house in a day? And the answer is, of course you could. I would be willing to give you $1 for your house. You could sell it to me. I would buy it today. It could happen very quickly. Hopefully, though, your house is worth a lot more than $1. So your house itself is not very liquid. There's something called the law of large numbers. As a sample size grows, its sample mean gets closer to the population average. So this applies to the returns you earn after making many investments over extended periods of time. So again, investing numbers are seen to imply efficiency or fairness because of the law of large numbers. So competitive financial markets tend to be extremely efficient because we have many investors thinking about and acting on information. So again, this idea of efficiency implies that information is embedded in the security price. So what are competitive, efficient markets? If an asset were undervalued, it would offer excessive returns, and investors would like to purchase it. So economic theory typically assumes a competitive, efficient market. Information is incorporated into prices, and new information changes prices. But because of the speed of trading, it's very difficult to take advantage of new information to achieve the entirety of the gains for those new events. So again, if we perceived that the asset was undervalued, we all would want to buy it. That drives the price up, and returns would no longer be excessive. If assets were overvalued, of course, investors would want to sell it, driving the price down. And this implies that prices are efficiently priced. So investors cannot expect to consistently beat an efficient market. Now, this doesn't mean you cannot make a return. It means that that return that you earn will not be more, or you should not expect to earn more than the average rate of return. So this idea or this concept of excessive returns, if an asset offered excessive returns, again, all investors would want to buy it. That drives prices up. So when prices are rising, ultimately that would reduce the return. Again, therefore, efficient markets implies that investors cannot expect to consistently beat the market. Since trading impacts supply and demand of an asset, it impacts prices. If everybody sees something as valuable, they all would want to buy it, and that would drive up prices. What is a well-diversified portfolio? This is a pretty complicated question, actually, and we'll talk about this much throughout the videos in this particular course. But if an asset is held in a well-diversified portfolio, some of its risk is canceled out. Asset-specific risk is that risk that deals only with that specific asset, and that is the risk that disappears, if you will, when we create portfolios. Systematic risk cannot be canceled out, as this is the volatility associated with investing in general or investing in the overall market. So diversification is a strategy to reduce risk by holding a variety of investments. For example, if your portfolio includes stocks from both tech companies like Google and consumer goods companies like Procter & Gamble, poor performance in one sector may be offset by the gains in another. So diversification is crucial because it minimizes asset-specific risk, though it can't eliminate this systematic market risk. Remember, the law of large numbers means as we have more and more assets, the outcomes of those assets average together, and we get closer and closer to a population average for an investment portfolio. So again, what are some key definitions? Diversification, holding a variety of types of investments like stocks and bonds. This potentially increases as the correlation between the assets declines. So we put assets together that are less and less correlated, we will get more and more diversification because they don't act alike. So diversification implies a strategy that can be employed to offset some of the company and industry-specific risks in each asset. Asset allocation is the process of diversifying an investment portfolio across different types of investments. So asset allocation refers to not spreading assets within an asset class, but across a spectrum. So for instance, the choice of a proportion of dollars invested in stocks versus the percent invested in bonds refers to the asset allocation decision making. So we're going to discuss this as our videos continue, as we talk about investing in general across different types of asset or instruments in finance. There are many kinds of careers in investments: security analysts, portfolio managers, financial planners, investment bankers, and many more. So you might pursue any one of these, and of course within those different career opportunities just in finance, there are designations that are also possible. So the professional designations, and again, there are far more than these. We have Chartered Financial Analysts, or CFAs, Chartered Alternative Investment Analysts, Chartered Financial Consultants, Certified Financial Planners, or CFPs. Again, there are many different certifications that you can acquire throughout your finance careers, and they reflect the different certifications, or they identify individuals that have expertise in certain types of investments or strategies. So that's the end of our chapter here. I look forward to talking to you soon. Bye-bye.